Sherman and Sterling. Nice to have you here, Michael. Stephen Lippin, Chairman and CEO of Gladstone Place Partners. Bob Maurice, President of McKenzie Partners. And last but certainly not least, David Peinsip, who's a partner at one of our hosts, Cooley.
Thank you.
Thanks.
Oh, this is fancy.
Okay, so I'm going to start with a question that I asked the last panel, but I think is just as relevant for this panel, which is, do you think that the current pace of activity, whether it's in capital markets or whether it's in activism or whether it's in M&A, is sustainable for 2022? Maybe I'll start with you, Wei.
Oh. Well, I'm going to take a pass on that question because I only work for one company.
Okay.
But you expect it to be busy, I assume.
No comment.
That means yes.
That is.
I think at a macro level, I mean, yes, you have all the drivers that are, there for M&A are pretty strong. You have, active capital markets, both in equity and debt markets. Bank financing is readily available. You've got private equity funds with a ton of dry powder. You've got a lot of SPACs out there that haven't de-SPACed yet. And you've got, a lot of public companies that have a lot of cash and high stock prices that are still looking to grow through acquisition. So at that level, I think definitely it's sustainable. For individual companies that have just come through a pretty busy year, maybe less of a challenge. I mean, if you're Salesforce and people have a dedicated or another large company have a dedicated M&A team, you can probably handle that. But in the past year, I personally worked with a couple of companies that normally are good for maybe one deal a year, and suddenly they're doing multiple deals at the same time or deals in rapid succession, and that puts a lot of stress on your internal team. And so for a company like that, I think it probably you got to stop, take a break. People have their day jobs too, and it is a little hard. It is harder probably organizationally to keep up that pace, at least for an individual company.
Yeah, I mean, I agree with Michael on the conditions right now are certainly good. I think it's really hard to predict anything in this new world, so we might not all be here in 2022. That sounds more depressing than I mean it, but I just mean that right now, looking at it, the pipeline is big, the money is there. We have sort of technology and life science companies that are transformational, and a lot of them have been planning to go public for a while. So at least on the capital market side, I see it as a big year, probably on sort of pace of 2021. I think SPACs will reinvigorate a little bit. So yeah, I'll let others speak to M&A, but I think we'll have a very strong year in 2022.
Yeah, I suspect that we're going to have a pretty robust year next year, assuming that the status quo remains, that the regulatory framework doesn't dramatically change or anything unexpected in terms of tax policy that might affect deal flow. But I do think we'll probably end up at the end of the day in a better place than we are, even though it's an extremely good year.
Yeah, I agree. I guess what I would say is that if you look at the trends, there are fewer mega deals, longer regulatory conditions and planning. So you have, of course, you have record stock market, low interest rates. As the markets go high, what do people do? They sell when prices are high. So people are IPOing, SPACing, selling their companies for stock. But per the earlier panel, do you want to go and get an HSR filing? Is it you're going to get a second request? The Wrath of Khan at the FTC, DOJ, they're all gearing up for what I think we all see as a very tough antitrust climate. And I don't think it's just a question of the mega deals. I think the mega deals may not happen because people are just maybe anxious about doing what may be perceived as high-risk deals. But almost every deal we're working on now, there's just a heightened concern about antitrust, extending out the dates by which we say when we're going to close. And I just think there's going to be a lot more scrutiny. I know they have a panel tomorrow, so I'll shut up and we'll...
Well, our panel is like the prediction panel for all of the rest of the panels, right? So I guess related to that prediction, David, I thought maybe you could go a little bit deeper into thinking about what you're expecting capital markets dynamics to look like in 2022. And I know you touched a little bit upon SPACs, but how do you think SPACs are going to relate to direct listings in 2022? What kind of resurgence are we going to see in the SPAC market? Are we all going to be SPAC'd out in 2022?
Well, we were SPAC'd out.
We were SPAC'd out in
we-
2020, yeah.
We lost interest a while ago, but look, I think that market saw an extraordinary amount of sort of digestion problems from just too much, too fast, and a lot of uncertainty, and frankly, some companies that just weren't ready to be public. So, you know, it flew too high, and then it went very, very low, and it's been that way for a while. But we are seeing signs that it's coming back. The pipe market's slowly opening up. We're starting to see the trading of announced deals come back to life a little bit, and we're seeing deals close. So I think SPACs will be around. I don't think we'll ever be the way they were, and that's probably good for everybody. But I do think there'll be a big component of 2022. IPOs are, you know, the market is super choppy, so you can never predict a particular quarter. But on a general basis, it's strong, and the windows are open, and I think we'll continue to see that. As I said, I think there was a boatload of backload of pipeline that we saw sort of going into what we thought was going to be a huge post-Labor Day IPO market, and it was good, but it wasn't great. Lack of mega deals as well, so we haven't seen some very large issuers we expect to go out. So a lot of that's backing up now, and there is going to be some pressure. I mean, this sort of COVID excluded 13-year bull market will eventually have to shift just from a macro perspective, and so the longer it goes, the more I think people will go there. We're also seeing some pressure, I think, on private company financing valuations, which will push people back to the public markets a little bit. So I think it's going to be a good year. I think it will we'll have some really great companies that will sort of set the standard early on, and then we'll have a lot of people that try to emulate that.
All right, so I've got some great data here from our friends over at SRS Acquiom. And kind of related to that, Michael, I wanted to talk with you a little bit in terms of how you think the shifts in capital markets are going to impact deal making, particularly in M&A. Based on at least some of the data that we've got here in terms of an increase in equity transactions, are you expecting that certain industries are going to be more aggressive in terms of M&A deal making than others in 2022?
Yeah, I think it's, historically, and looking at last year as well, the main industry in M&A has been tech. I think that'll continue. But the other thing that's important to note is that, tech has really permeated into all other industries as well. There's a lot of industries people have realized you've got to innovate, and even kind of more old line industries really need to innovate in order to stay competitive, and that's both because COVID has really driven home the need for both remote working and also technology for business continuity. Data analytics are important in all industries, and that's just also where innovation is coming from. So you have in insurance companies, they're looking at insurtech companies, and in real estate and construction, they're looking at prop tech. Automotive is a huge area where technology has really been driving all the growth. I mean, putting aside like the main, technology-focused corporate venture capital investors, some of the biggest corporate VCs now are, the car companies, right? You have Ford just been investing in Rivian, and GM had invested in Nikola, and both in electric vehicles, and Volkswagen had invested in QuantumScape and battery technology. And you see a lot of investments in autonomous driving, and the chips, and the sensors, and the software that's necessary. So I think a lot of these kind of tech-enabling technologies for other industries are going to be really important as well. In energy, it's the same thing, where you have energy companies investing in smart grid and other technologies so they can reduce their carbon footprint and be a little cleaner. So I think you'll see that kind of across the board, both in tech and non-tech driven industries, with technology really being critical. The other thing, just to finish on what David said, was one of the points you made about SPACs is you do a lot of these companies that probably have no business being public, and I think you'll probably will start to see some of these companies out there probably that have de-SPACed in the last year or two figure that out and get either taken private by private equity funds or bought by other strategics, just because you have a lot of companies that probably belong part of somebody else, not a standalone public company.
That makes sense. So we've talked a lot about the regulatory pressures, both in the last panel, and I know we started talking about it in this panel. Wei, I guess I'm curious, but I would like others to chime in, maybe after you chime in, just how are you preparing, I guess you're one client, right? How are you preparing your client for both domestic and cross-border regulatory challenges going forward? How does the current regulatory environment sort of impact how you're managing your teams and their expectations currently?
Yeah, absolutely. So for those of you who haven't been following Salesforce's development and acquisition history, that we acquired a company called Tableau That's a $10.5 billion acquisition that we closed in August of 2020. We have, the day before, July 31st, we receive IEO, initial enforcement order from the CMA, which is the regulatory body from an antitrust perspective in the UK, and went through this 3-month process of trying to get that IEO lifted. So that's one first traumatic experience for me, in terms of my career as an M&A attorney. And then last year we acquired Slack. We signed the agreement to acquire Slack, which is a $27 billion company, the second largest in the enterprise software business at that point. I have to say, we initially conservatively estimated the chance of getting a DOJ second request as 50%, and yet we got it. Took us more than 6 months to close the transaction, but successfully. So based on those two experiences, how do I prepare my team and the company in general to face these kind of regulatory scrutinies? One is we educated our executive team and board really well. For example, about a couple of weeks ago, we all know that Facebook actually got fined 50 million pounds for violating IEO by the CMA. So, when I was reading the article, it's just bringing back all these flashbacks. They do have very, very strict protocols that sometimes borderline on, how could this be real type of requirements. So for example, we had a lot of back and forth negotiations on the fact that we asked the target company board of directors to resign after the close of the transaction, which is considered as very standard in the US, but it's a big warning sign for the UK, because directors there means a completely different concept as directors here. And so we spend months going back and forth on that one issue. And for those of you who now are dealing with the CMA on the board of director issues and get that clear very quickly, you're welcome. And then things like educating our entire company. Not only we have to educate the board, educate our CEO, who has to personally sign a personal affidavit every other week certifying compliance. This compliance is going all the way up and down through the food chain of the entire 50,000 people within the company at the time. So that kind of level, suffice to say that we were so successful in empowering and educating our entire workforce. Every single employee at Salesforce knows what CMA is. And then all these compliance programs goes all the way up to the level of all of your long-term range plan that needs to be submitted. Millions of documents were turned over during this whole process. And then making the product team understand that you can't just randomly call your deck of aspiration a long-term range plan, right? So we had to spend months trying to clarify to people that that was a deck that the CTO has never seen, and there was no budget for it, and all of those things. So it was a huge educational process for us. And so ranging all the way as sophisticated, as high level as that, but then going down to the minutia of, we have this tradition of sending people cupcakes with logos of two companies together. We couldn't do that. So cupcakes had to be canceled.
That's the fault of the regulators.
Had to be canceled
Cancel
the
culture.
day before. We had 3 days to put together this compliance program that binds 50,000 people, right? And then that was the one of our executive meetings, and where we invited the Tableau executive team to go in, but then we have to design all these different colors of lanyards to make sure that the Tableau people do not talk with the Salesforce people at the event. IEO is something, the CMA regulation is something that, goes very counterintuitive. It's almost like once you are under IEO, you couldn't even talk, you have to take 5 steps back from even before you sign the transaction, so like all these normal course activities that you used to be able to do, the conversation, the ordinary course conversation that you used to have, none of that could happen. So it was a big eye-opening event for us. And then I have to say, like the entire team, including me, at one point was skeptical of like, are we being too conservative? Should we, like stand up a little bit against the regulators? We eventually made the decision of like, building the trust relationship that we have with CMA. And I have to say, like, after that, we have had 2 sizable transactions where the CMA was, involved. And, knock on wood, they trusted us.
Steve, do you want to chime in on the regulatory issue?
Well, I was actually almost going
Yeah.
to ask a question, which is,
Yeah.
does a Slack deal happen in 2021 or 2022?
That's what I'm wondering.
And will companies take the plunge on a mega deal in this environment? And maybe it's rhetorical, maybe we can talk about it, but I just wonder whether deals that are above the fold in the Wall Street Journal, it used to be like you wanted to be above the fold. Now our clients are like, I don't know, do I really want that kind of scrutiny right out of the gate? So, not sure if you have a view about whether these deals are doable now in this, in this climate.
Yeah, what do you think?
You might have to pay more than $27 billion.
I have to say, like, the business needs to transform. If there is a target that is sizable, but it's going to transform the business, and the transformation is a matter of survival for the acquirer, they would have to take the plunge. I'm not familiar enough with the banking industry or like, the travel industry, but I've definitely seen a lot of consolidation there, and it's a matter of survival, right? So. Yes, like there will be regulatory scrutinies, but the business case always trumps the regulatory scrutiny that you have to deal with, is my view. So,
Michael, how does the regulatory scrutiny sort of impact the way that you're giving advice in terms of preparing your clients for moving forward for 2022?
Well, I think two things. On the antitrust thing, which I think was largely well covered, but the key thing is you have to really have a plan B going in. You've got to think that there's a greater likelihood of deals getting blocked, and you can't wait until you get the notice to say, what are we going to do? And so you've got to anticipate, early on in the planning process, what's your plan B, what's going to happen, both on the buy side and the sell side, if this deal doesn't go through. Are there other prospects, other possible candidates you can look at, other potential buyers, and really thinking that through. The other area we haven't talked about besides antitrust is foreign direct investment regulation as well. And in the U.S., we had FIRMA coming out amending CFIUS, making that more aggressive in 2018, which created a lot of uncertainty for several years. You had, because that came out, and then you had a couple of years of rulemaking. I think the final rule didn't come out until October 2020, and that created a lot of uncertainty. And for a while, U.S. companies were, if you were a seller, you would look, you'd favor a U.S. buyer over a foreign buyer because that was just one less uncertainty, one less approval you had to look through. I think now that kind of the rules have largely settled down, people now have some practice and some experience dealing with CFIUS. I think it's probably not as scary as it was, at least if you're a buyer from a friendly country, from Germany or Japan or France or something, where I think people are getting a little more comfortable proceeding with with foreign buyers and not moving towards the U.S. buyers. On the other hand, I think you do have a shift towards protectionism around the world, and the UK has a new foreign direct investment law. The EU has one as well, and I think you're probably going to deal with that, not just here with CFIUS, but globally, greater pressure on cross-border deals.
So we're going to turn from scary regulators to to other pressures that companies are facing. And I thought I would start with you, Bob. So companies are facing ever-increasing pressures from shareholder activism. Maybe tell us a little bit about what's your outlook for activism and hostile activity in 2022, and what should companies be prepared for?
Sure. So I think the early indications that we're seeing in conversations with our clients, prospective clients, fellow advisors, and many of who are in the room here, and market observers, is that it's going to be a robust activism, a robust year for activism in 22. I would expect it to be materially above the current levels that we're seeing, maybe even at pre-pandemic levels. And in terms of how companies should prepare, what they should think about, certainly if you're coming out of the pandemic and you're a performance laggard, I think that puts a target on your back. But also I think companies need to be mindful, and I think they're getting their heads around this, that ESG activism is probably going to multiply significantly in the coming year, not just through 14A8 proposals, which we've all dealt with over the past many years, but challenges to directors and board seats. The takeaways for the companies, for the issuers, should be that you have to, through the prism of an activist, look at your ESG hygiene, in particular the G, look at things like diversity, board tenure, not surprising, the things that we've discussed, ad nauseum. Also, they should, coming out of this kind of, hibernation period, if you will, issuers should start really thinking about fulsome engagements with their shareholders. You really need to get to know your shareholders and make sure that you have open lines of communication with them, so that when you do go to them to try to get their favor in terms of a vote, that it's not the first time you're speaking to them. And I think, lastly, one of the things that's important is to understand who your shareholders are, which is something that we do and many of our competitors do, is understand the shareholder base. In particular, think back in October, BlackRock had indicated that they are going to start giving some of their voting authority to their issuer clients. I don't think anyone really has a sense of how that's going to impact annual meetings, let alone in the contested space. But it's something that you should be concerned about, because that big chunk of shares that you would anticipate coming from BlackRock may not be there, or may be there to a lesser degree. So that has to be something that's part of the calculus when you kind of start counting heads and deciding how you're going to fare, and should you have to go to a proxy contest with a competing slate of dissident nominees.
Where do you think the biggest pressure points are going to be in the E, the S, and the G? You've indicated a little bit the pressure point on the G for 2022, and we've seen that from some of the shareholder proposals of this past year. But we're getting beyond the board of directors on issues like diversity. So where do you see some of those pressure points?
I think, depending on the industry, although everybody's vulnerable to it, I think environmental is particularly, obviously, the recent meeting in Scotland, there's a lot of focus on it. There has been a lot of focus on it. And I think that, every industry and every issuer is susceptible to questions about their environmental practices, and that's certainly something that is going to be is a theme that we should see in the years to come.
So how does that factor into your advice, David?
I think it's becoming an increasing factor in almost every company that I talk to that's considering whether to access the public markets. But I think the really interesting thing is that I think there's a coming clash between the ES and the G, to be perfectly honest, because G has largely been the focus of shareholder activists and frankly institutional shareholders, because they want to protect investments of Wall Street and others. And there's a lot of companies, particularly in the tech space, that have been driven more to poor theoretical governance standards in order to avoid exactly that, right? They don't want to have to worry about whether BlackRock's going to hand over the vote when it comes to. So that's why we see sort of the Snaps of the world taking those decisions out. But I think the more interesting new thing is there's a lot of companies who deeply care about ES, probably at a level at which institutional shareholder groups don't care as much, or to the detriment of near-term results. And so I think the interesting thing is sometimes really good governance can put a company in a position where they can't necessarily achieve their own goals when it comes to the E and the S part. And so, if you look at sort of an Allbirds type IPO, right? A company that is far more committed to environmental and sustainability than sort of institutional investors on Wall Street are probably going to be focused on, and they want to have the freedom to do that. And so I think it's going to bifurcate a little bit, and I think we're going to see some clashes between these different areas, particularly with tech companies that are heavily focused on sustainability and diversity.
Yeah, and I think also it used to be that your stock price was the best protection against an activist. And that while that may still be the case, if it's at the expense of the environment, if you've made no discussion about net carbon zero, if you treat your workforce poorly, if they're on strike, so there's, back to your S point. So, Bob made a point about looking through the lens of an activist and also looking at your company through the lens of an ESG activist or a social activist.
It's also relevant to how you present a deal, right? I mean, typically what you do is you try to show that it's good for your shareholders and it's good for your consumers, and you'd stop at that, and that's your audience. And I think now, even if you're not a PBC like Allbirds, you probably would have to take into account, or at least be ready to address other concerns. What is the impact on ESG? What's the impact on employees and on worker safety and on and ethics and other things as well, that you just need to be able to respond to that and either include that in your deal rationale and when you roll out the announcement, or at least be able to anticipate and potentially have some opposition on that approach as well.
I mean, one of the biggest concerns people have in doing deals is what it means, and I know you had a conversation, the prior one, about the people part of it. 20 years ago and 15 years ago, we would focus on how many jobs were being lost as a good thing. And you all did it, so don't look at me like I'm the bad guy. Because that's just the way the world worked. You cared about Wall Street, you cared about your investor base, that's who you were selling the deal to. And you touted your synergies and all that. And that worked for a long time. I cannot remember the last time we, other than talking about how we were going to treat the employees of the combined company, minimizing synergies, at least in the press release and things like that. So it's a much different world now.
I would love for you to weigh in, given that your company's commitment to ESG issues.
Absolutely. For us, we're very fortunate to have a visionary leader that who is currently very much focusing on environmental and sustainability, and he had the 1 trillion tree movement, and trying to move the whole world ahead in terms of environmental protection. So one of the things that we need to talk about is the fact that we need to look forward at the future investors. The future investors are the 20-year-old and the 30-year-old sitting at the table and beyond, and they're going to look at a company by looking at, are they protecting the environment in a way that my kids and my grandkids can enjoy the earth in the way that I do, or even better, and then that's the company I wanted to invest. So, I mean, this is definitely not forward thinking to the extent that it's being revolutionary. It's really a necessity, and I think the philosophy of Salesforce, which is the business of the business, is to improve the state of the world. So whatever that is, the most pressing issue that we face as a humanity, which is there's no better. No other priority matter except for, environmental protection. That is something that we absolutely have to focus on.
Let me ask a follow-up question on the activism question, related to some of the other things that we've talked about, which is, has this SPAC boom created a new breeding ground for activism targets?
Bob, you want me to go?
That's for you.
I think it certainly has. I think what we see is after the de-SPAC occurs, the sponsor ownership decreases, so that block of 20% isn't necessarily there, so there becomes vulnerability to performance. There's performance issues that we've seen in many de-SPAC companies. So if the assets are worthy, and I think that was a point that was made earlier, if the assets are worthy, it does open the door for potential hostile.
Well, they are.
Maybe the right word.
It's hostage. You become a hostage.
So a hostile offer is possible, but also there's just some opportunistic activism for a company that as we said, shouldn't perhaps have been brought public in the first place. So I certainly think that there's going to be more and more of this de-SPAC company activism that we're going to see going forward.
And more shares in retail earlier on, right?
Yeah.
We see companies that have trouble getting the vote to approve the de-SPAC, even when economically it makes no sense not to, right? And so
Right.
even that, just because the shares are so spread out.
Yeah, that's an issue that Steve and I worked on a project that had 1.2 million holders, and it was a complete nightmare to get them to vote. I mean, some of the brokerage firms just are basically uncooperative, and it just becomes almost like a video game, the trading, without the recognition that it's important to vote as well. And there's no mechanism in many of these shops to affect a vote. So, I think there's, I'm not going to mention names, but, efforts have been made or are undertaken now to try to help with the voting process. But at one point, we were getting yelled at by our client that the phones weren't being answered, but we were getting like 1,000 calls an hour. I mean, that's.
And we were getting the overflow.
He was getting the overflow, and I was getting.
And Lauren was getting the overflow from the overflow.
I was getting emails from Lauren telling me, you got
At 1 o'clock in the morning.
You have to answer the phone. We had the calling center going 24 hours a day. It was just insane, and it was a nightmare. I think we ended up going into the office. We were home, and I think Dan and I got there at like 1 o'clock in the morning, and we were answering calls. So the retail holders is problematic. I mean, it's encouraging that people want to be part of the process, but it's a big problem.
And you don't know which deals are going to end up. I mean, one of the lessons from the Lucid Churchill 4, and I know Emily Roberts is here, she worked on it on the Lucid side, and we were on the Churchill 4, is who are your shareholders by the time the vote comes, by the time the record date? That you really need to know. And by the way, these guys are the best in the business, and it was still impossible to figure out.
We had seen the shareholder base turn over something like, I think it was 40 times the shares outstanding had traded between the announcement of the de-SPAC transaction and when we got to the meeting. And so there was just a tremendous amount of churn in the shares.
And to David's point, it wasn't like there were people voting against it. I mean, the stock was at 25, par was $10. It was just, oh, do I really need to take an action? I had so much fun on my Robinhood app. It's like, yes, you need to vote to get your $26. Otherwise, it will turn into $10. And that was, there were a lot of lessons from that, for sure.
Most definitely.
David, do you want to chime in on this? Because I
Yeah,
feel
I
like
mean,
the
that's-
disclosure point and getting people to vote is challenging.
I think that says it all. And look, it's not just in that context of the higher retail and the de-SPACs, which is a big component. We're just seeing retail more on the IPO side too, obviously with the advent of Robinhood and other retail organizational sort of institutional ways to get shares, which is a good, positive thing. But it all goes back to the same idea of, who's going to make the decision for this future public company about how they drive their business, and increasingly as we think about the ESG, as we think about sort of these dynamics in the markets, at least on the company side, the big question is how do we protect ourselves now from that future? And I think one sort of corollary in all this that I think is going to become interesting over the next couple of years is, other than in some small sectors of the universe, E and S are relatively agreed upon by society, but there's going to be like a political piece of all of this that's going to be extraordinarily difficult to deal with. We've already seen it a little bit with some of the stuff from last year, but I think you're going to see it in terms of sort of political donations, and there's an entire aspect of this that companies are going to have to navigate that's going to get really complicated. And obviously Facebook has to deal with it, Salesforce deal with it from the more positive side. And so we'll just see how that plays out a little bit, but we already have companies thinking about, okay, I can set up an ESG committee. I can sort of try to figure that out, but how do I play into this harder notion of what we should or shouldn't be doing from sort of a political standpoint? Let's save the environment, but can I do that and also give money to X person?
Yeah, so that kind of anticipates my next question, and we only have 4.5 minutes, so this is
Sorry,
like a big
I segued
question.
for you.
Right, you segued it for me, so thank you. But this was a thorny political environment over the past 2 years, in addition to the pressures with respect to ESG, cross-border cybersecurity breaches, kind of all of these concerns create a lot of risk for the company, and like the risk of a media firestorm and things just going super wrong. How do you prepare people for like the expectation that something will go wrong in 2022, Steve?
Yeah, that's a nice way of putting it. And it's sort of why I think all of the professional service providers are in business, which is we can pretty much count on something going wrong for the many public companies that we support, not because they're doing anything wrong, but because of a bad tweet or, you know, litigation that one side or the other wants to expose, bad actors, I mean, you name it. You're never going to have a playbook. So what it really comes down to is like your principles when you go into crisis mode. Who is the team? How do you interact between all the disciplines? The silos have to come down. Everybody has to have a seat at the table, whether it's comms, legal, finance, IR. The board has to be kept up to speed without scaring them, and then they all think that I'm not a PR expert, but is a word we've heard many times over the years. You know, being nimble, but also not panicking. I think sometimes clients will want to, well, we have to get something out. We're going to have to deny. We're going to whatever. Well, let's get the facts. Let's get the facts first. When I left journalism and got into this world, my first client was Enron, and
It's your fault.
Ken, exactly. And Ken Lay's daughter said, you know, we got to get our side of the story out. And one of the top lawyers in the country said, put his glasses down and just said, just what is our side of the story? So until you know what your side of the story is, you're generally not going to get out there swinging. So those are just a few thoughts in mind.
Do you want to weigh in on this way?
Absolutely. Value driven, have your mission and North Star, and stay true to that.
All right, so we've got 2 minutes at the very end, and I thought I would do something like we're going to hold you to, I guess, at next year's forum, which is your one bold prediction. You could be as bold as you want to be. Your bold prediction for 2022.
We will all have data at our finger point when we are at the table with the executives making decisions. Give you an example, right? You know, like now, you know, the ubiquitous question, which is what's market, right? You know, people are always like, oh, well, you know, I think this. Let me send an email to my firm, other colleagues, and I'm gonna gather the anecdote, you know, for you. In 2022, we will have the data at our fingerprint. So, for example, I have it now because I founded this nonprofit organization called the Atticus Project, and we're working with the American Bar Association to relaunch the public target deal point study. Out of the 102 deals closed through October 2021, there are 11 of them have a go shop. 8 of them are financial, sponsors, and two of them are strategic, and one of them is a management buyout. So I mean, you really need that real time. You can't be just calling other people and then try to add value. We're looking for people to add value based on all of those data.
Your bold prediction.
Well, the last time I was asked this question, I was dead wrong. I think I predicted that European-style vendor due diligence would make its way into the U.S. market, and that hasn't happened. So, I think what will probably happen, is, you could have, big issues coming out of small deals. I think somewhere this year there'll be some small deal that causes a huge blow up for somebody, whether it's a, data breach or something, where I think people will start to rethink how they think about diligence and approach and governance, board oversight, even on the smaller deals, because there could be time bombs in some of these things, and people sometimes may ignore them. So I think that will kind of force people to refocus kind of their governance process and their diligence on even the smaller deals, to make sure you're not having some of these really negative cataclysmic events coming out of a smaller acquisition.
I think D&O insurance premiums are going to go up.
I like that.
I think in the back half of 22, SPACs are going to probably take a back seat to IPOs, and they're going to be perhaps not as in favor as they currently are.
My prediction, I'm going to be bold, okay, Dark horse candidate for CEO of Waystar Royce, cousin Greg.